Guys, I have something very exciting for you today, and I can't wait to share with you guys. In today's video, I'll be talking about what recently became my most profitable investment property. I will be sharing with you the numbers, the rental returns, and the insane capital growth that I have seen on this tiny little investment over the last 3 years, as well as my thought process and the reasoning behind why I decided to invest in this market that was overlooked by many investors just a few years ago. The aim of this video is not to brag or show off or tell you guys about how great I am, because I know I'm not. All I did was do my research, and I'm very happy that it paid off. I received a lot of feedback in my comment section and on my Instagram, and the most requested topic from you guys was one involving my process of finding the perfect investment property. So in today's video, I'll be sharing with you my exact thought process and the 3 main reasons that led me away from my hometown of Melbourne and into this tiny little market. I personally believe the strategy of just throwing money into the biggest and most expensive markets of Australia is no longer the best strategy. And in today's video, I will show you exactly why. As always, this is not financial advice, and I am not a financial advisor. This is simply my personal opinion that I'm sharing with you guys. I will always encourage you to do your own research and due diligence and consider seeking help from real professionals before getting into any big investment decisions. And without further ado, let's get straight into the video. I will start the video by first talking about the numbers behind the purchase, the rental returns, and the capital growth. I will then move on to talk about my thought process for choosing this particular market and this particular property, as well as some historical data and factors that aided my decision making. The property itself is nothing special. It is a nice brick house built in the 1950s, comprising of 3 bedrooms, 1 bathroom, an old-fashioned kitchen, and a very simple layout. What is special about the property is the massive block of land that it is built on, which I plan on taking advantage of in the coming decades when I'm ready to turn this house into 3 or 4 townhouses. I purchased this property in January 2018 for $245,000 after putting down a 20% deposit and paying the associated expenses such as stamp duty, building inspection, and legal costs. My total investment added up to be $58,200. The property was rented out for $310 per week just a few days after settlement was completed in January 2018, giving me a rental return of 6.6%, which is pretty damn good considering the best I could find in Melbourne was around 4%. Another thing to note here is that this property is located in a market with a housing and rental shortage, meaning the vacancy rate is pretty much 0, which in turn means I have been able to achieve a steady growth in my rental returns. To keep things interesting, I am not going to tell you guys where the property is located just yet, but I'll keep giving you hints, and hopefully by the end of the video, you guys will know exactly which market it is. If you guys guessed the market before the video, let me know in the comment section below. The tenant who originally moved in 2018 has just re-signed for another 12 months, and the rent has gone up to $330 per week, meaning my rental return has now increased to 7%. At the current low interest rates, the property puts a bit of money into my pocket at the end of each month, despite me paying both principal and interest. After taking into consideration all the expenses and outgoings associated with the property, such as maintenance costs, management fees, water fees, council rates, land taxes, and all of those, the property is still slightly cash flow positive. Now let's move on and talk about capital growth. And I think this is what you guys are most excited about. Even though I love capital growth, and there's nothing wrong with a strategy that focuses on capital growth, but I believe every good investor should focus on both capital growth and rental returns, because your combined or total return is your capital growth plus your rental yield, and that is your real return. For example, an annual growth of 10% plus 2% rental return is going to give you a combined return or total return of 12%. But an annual return of 8% plus a 6% rental yield is going to provide you with a combined return of 14%, which is 2% higher. Too many investors focus purely on capital growth and they completely forget about the rental return, and I believe that is a mistake. Based on the most recent valuation by the bank, the property is currently worth around $400,000, which I think is still a very conservative figure. considering the future development potential of this property, which I think will become a bigger and bigger driver for price growth as this market becomes more expensive and attractive to developers. Based on the current valuation of $400,000, the purchase price of $240,000, my total contribution of $58,000, as well as the fact that the property has been cash flow positive from day one, meaning I haven't had to contribute any additional money towards the property, I have made an equity gain of $145,800, which is equal to a return on investment of 250%, or annualized return on investment of 48%. I am extremely happy with these numbers because one, it beats the bank interest, it beats inflation, it beats the stock market, and most importantly, it beats the performance of the Melbourne and Sydney property markets. The best part about this is that those returns we have just seen is only based on the capital growth. If we then add the rental returns towards it, we're going to have a growth that is much higher. If I then add the rental returns to get the combined returns, I'll have a combined return on investment of 340% over the last 3 years. To achieve a similar result in Melbourne, this is what the numbers will have to look like. If we purchase a property for $800,000 and we wanted to see the same 63% growth in 3.16 years, the property will need to be worth more than $1.3 million. This is simply not a number that we are likely to see in such an expensive market. Even if the Melbourne property market saw a growth of 63% over the last 3 years, the rental returns for this market will still be much lower. This means that you will need to be much closer to 70% for Melbourne to be a better investment. And if we wanted to find a better investment in Sydney, we will have to find a house for $1.2 million and have it grow to about $2 million after 3 years. As you can see by these numbers, investing in the most expensive markets is not always the best strategy because these very expensive markets have much less room to grow. And this is the first reason that led me away from Melbourne and Sydney and into the coastal market that I decided to buy this property in. Yes, I know the market being expensive is not a valid reason to not invest in it, but there are more to this, so let me talk about this a bit more. To do this, I'm going to talk a bit about my investment strategy and how it influenced my decision making. I have always been a firm believer that spending more time in the market is more important than trying to time the market itself. So my goal from the start has always been to build up a property portfolio as quickly as possible. When I was trying to build up a portfolio as quickly as possible to get more exposure in the markets, Melbourne and Sydney was simply not an option for me, because it will take a huge amount of time for me to save up a deposit for these markets. And even after I save up the massive deposit required to get into these more expensive markets, I will still have to contribute additional money towards these negatively geared properties every single month. Because let's be honest, it is almost impossible to find an investment property in Melbourne or Sydney that is cash flow positive or not negatively geared. If I'm constantly contributing money towards these negatively geared investment properties, how am I going to save up for the next deposit and the one after that? So as you can see, investing in Melbourne and Sydney was simply not in line with my strategy. Now, don't get me wrong, because I know a lot of investors in Melbourne and Sydney who have done extremely well over the last few decades, but these investors also have very high incomes, and negative gearing and the tax benefits were perfect for them. However, because my strategy was focused on building up a portfolio as quickly as possible, Melbourne and Sydney were not for me. Then I ran into a second issue, and this was the issue associated with capital growth. Because when I first started investing in these smaller markets, my friends and family all told me the same thing.
The biggest and most expensive cities have performed better over the long term, and they will continue to perform better in the future.
Instead of taking their advice, I decided to do my own research into the matter and find out if this was true or not. So I went and got the housing data over the last 40 years from the Australian Bureau of Statistics and put together this little table summarizing the performance of all the capital cities, excluding Darwin. I have updated the table to include the latest data for your reference. What I found was that over the last 40 years, Melbourne was by far the best performer, with a growth of around 2,000%, which is around 500% better than all the other capital cities. However, the issue here was that Melbourne was not the most expensive or the biggest capital city in 1980. It was in fact the fourth biggest and fourth most expensive, meaning that if we decided to invest in the biggest markets back in 1980, we would have most likely invested in Sydney and Canberra and maybe even Perth. And if we look at the performance of Perth, it was by far the worst performer, and Sydney didn't do that much better either. it produced a result that was very similar to most of the other capital cities. If you look at the last 20 years, we will see that Melbourne once again performed well, but the best performer was Hobart. So to answer the question, does the biggest and most expensive cities always perform the best? The answer is no. And this was the second reason that led me away from Melbourne and Sydney. The final reason why I chose to invest in a smaller market was due to one very simple yet very important factor: the supply of housing. To look at not only the current supply of housing, but the future supply of housing going forward, we need to look at a number of different factors. The most important one is its profitability for developers. Because Melbourne and Sydney are such expensive markets, there are huge margins to be made by developers. And this in turn has encouraged developers to do more developments in these markets. For example, the cost to build a 3-bedroom, 2-bathroom townhouse is around $300,000 to $350,000. A developer in Melbourne can buy a house on a big block of land for $900,000, subdivide it and build 3 townhouses, and they can sell the townhouses for $800,000 each, giving them a profit of around $400,000. However, with the median house price in smaller markets being around $400,000 to $500,000, and it costing around $400,000 to build a new house, you can see already that it is not very profitable for these developers to develop in these certain markets. And this in turn is going to mean that there will be less developers adding to the housing supply in these smaller markets. And this is what we have seen in the last decade, with the housing supply in both Melbourne and Sydney absolutely exploding. And we have not seen the same level of increase in housing supply in these smaller markets. And this in turn has led to a housing shortage. This is also reflected in the vacancy rates. As you can see here, the vacancy rate in the market that I invested in is only 1%, which is much lower than the 3 to 4% typical of Melbourne and Sydney. When there is a shortage of housing in a particular market, it's going to do a number of different things. First of all, it's going to drive up the pricing of housing. And second of all, it's going to increase rental returns in that particular market. And that is exactly what I've been seeing in my investment property over the last 3 years. Strong price growth and strong growth in rental returns. These are the 3 main reasons why I decided to not invest in Melbourne or Sydney, but instead direct my attention towards these smaller markets. However, there are also numerous other reasons, factors, and data that have contributed towards my decision. I would love to list everything here, but it will honestly take us hours. But these are great starting points for you to start conducting your own research and find out exactly what strategy will work for you. And like I said at the start of the video, I will always encourage you to do your own research and due diligence before making any big financial and investment decisions. Now, I've given you guys a few hints throughout the video. Have any of you guys been able to guess the market I'm talking about? Let's sum up all of these hints together. 7% rental return, shortage of housing, low vacancies, a median house price of $400,000 to $500,000. If you guessed Hobart, you're very close. It is actually Launceston. As much as I would love to have another property in Hobart, at the time of my purchase, the Hobart property market was simply too competitive for me to find a good deal. So I had to look elsewhere. Launceston at the time was very similar to Hobart, and it had many of the same growth fundamentals, but it was still a buyer's market. So I took advantage of the situation and got myself some very good investments in that market. The property is in a suburb called Trevelyan, which is right next to Launceston and right along the river, close to a lot of amenities including schools, shops and hospitals. I have had no issues with the property or the tenants in the last 3 years. It has honestly been a dream to own this property. This brings us to the end of the video. I want to thank you guys for watching till the very end, and if you guys got value from the video, please support the channel by hitting that like button right there and subscribing to the channel for more content just like this. If you have any questions or just want to have a chat with me, feel free to message me on Instagram at investwithzeng. I wish you the very best on your investment journey, and I'll see all of you guys in the next video.